beginning, an entrepreneur does many different things and trying things out. The tendency is to keep doing that. But what you want to do is actually focus on the one thing that's actually working. And so instead of shiny object syndrome, to focus, Kaio's taking his pound of flesh. They think that a lot of accelerators have put their pants on before their underwear. I can't imagine a future where people will not be eating avocados. As Jeff Bezos says, instead of thinking about like, how will the future be different? How will the future not be different? You can't imagine a world where people will want higher prices or they'll want slower delivery. It's not going to happen, right?
Hi, welcome to the Startup Evangelist, Ideas for Africa. My name is still Danielkitwa. I'm joined today with Mr. Kyle Schutter, CEO and founder of Kuzana, an accelerator for boring SMEs in Africa. I'm sure you'll tell us more about it. Karibu.
Daniel, thanks so much for having me on the podcast.
Yeah. I'm
excited to be here.
Yeah, so you have a very interesting background. I think what will be helpful for our audience is just to get to know you a bit in terms of key personal and professional highlights that sort of led you to the chair you're sitting on, particularly, focusing on the African SME investing landscape. Yeah.
So I came to Nairobi in 2011. So it was a long time ago. And I had a biogas business I started. I just had this idea in university. I think so many people in university can relate to this, where you just have something and it's just got to come out of you. You just got to do it. And you have no experience. And it's like laughable. The amount of inexperience I had was, the fact that, anyone should have, everyone told me that it was not going to work, right? And I'm just, I'm going to do this thing, right? I'm going to go to a country I don't know, in a language I don't speak, in a culture I don't understand. And I'm going to sell biogas systems to, farmers with 2 to 3 cows. And that was the idea. And, well, it was tricky, right? It was tricky. We raised some money. That was good. We installed something like 500 biogas systems for farmers. They were really happy. I went to visit one of the farmers recently. He's actually Jewish. He's one of the few Jewish Kikuyus in Kenya. I think there's only 3,000 of them. And he's still happy. It's still working well for him. He's very happy. His wife's very happy. She's not cooking on a 3-stone fire anymore. But we were never able to make a profit. And then accidentally, I started a Thai restaurant. And that was on Gong Road next to...
In parallel to...
It was somehow a little bit in parallel, but towards the end of the biogas one. And that one, it was accidental. People just started asking me to cook. They started paying me. One thing led to another. I never raised any money. I just bought something with the profits I had. I bought some more. I didn't even buy the licenses up front, right? So I didn't even have a liquor license. Someone showed up from city council, like, you need a liquor license. And I'm like, I guess I do. And they're like, I can help you. I'm like, great, So it was actually a very collaborative thing. They add their piece onto the cost and they sort me out. And, you need a music license, you need like a business permit and all these things. We just got these things one at a time. And that was profitable from the first month. And so I realized if you sell to, low-income farmers, it's very hard for them to pay you. If you buy from farmers, a restaurant, and you sell to rich Nairobians and expats,
you're almost reversing the supply chain. Like
exactly.
Turning your buyers to suppliers.
Exactly. So you'd have more pull than push. And I was like, wow, I'm not a bad entrepreneur. I just chose the wrong opportunity. Which is something that's very valuable, I think, for people who are just getting started. The opportunity matters more even than your talents.
Interesting. So, biogas, Thai restaurant. Then what happened after that?
Then I went to Silicon Valley for a bit. I wanted to learn sales. And so I did that. But Silicon Valley didn't really feel like my place. People would be like, ooh, Africa, that's so dangerous. What were you doing there? And I'm thinking, like, literally everyone I know is starting businesses in Africa, right? And so it was a bit of a weird experience in Silicon Valley. And I went to Asia, did some sales there. And then I just didn't feel it. I didn't know, it's going to sound a bit dark. But I felt like I was a waste of oxygen. Like I felt like I had talents and I did not know what to do. And so I had a motorcycle. It was a crotch rocket, a Ninja 900cc motorcycle, and I went south. And I decided to go south to figure out what to do with my life. And so at the beginning, I was retired. I could have retired in Mexico, bought some land, had a little small farm, found a wife, something like that. And after 2 months having mojitos on the beach, the depression got worse.
Yeah.
And so I realized that being able to do whatever I wanted, not working, was not actually what I wanted.
Yeah.
So this retirement, I always say retire early, retire often, if you can.
Yeah.
And after a few months of retirement, I decided that wasn't for me. So I started a few different businesses. One of the businesses was to raise capital.
Yeah.
By the time I got to Colombia, I decided to start raising capital for my friends back in Kenya.
Was this now through Grant & Co. or separately?
Exactly. Okay. So I started a company, Grant & Co.
Yeah. And then what did you learn from like switching from, operator to now supporting, other operators, either from a capital or acceleration perspective?
Yeah. I think there's different personality types.
Yeah.
So there's two personality types of entrepreneurs.
Yeah.
There's the people who are very focused, and then there's shiny object syndrome. And people probably go through phases, but you have 27 business ideas before you wake up in the morning. And as an operator, that was a very dangerous syndrome to have, because you start, telling your team to do this and that, and there's no focus. And as a consultant, you can do like anything, and every day is a new business problem, right? You can't work deep on the problem. There's problems you can't solve because it's not in your control. So that's the downside, right?
Yeah.
The classic like McKinsey consultant, they become frustrated because they can't actually solve the problems they see.
Yeah.
But you can work on many different problems. I guess the thing that I realized in my first business, in the biogas business, is you want to do consulting basically before, if you can have someone else pay you to learn, that's the best scenario.
Yeah.
If you can have someone pay you to learn. And actually, if you remember Sanergy, I built their third and their fourth toilets because I was a consultant for them. And that's how I kind of got started doing biogas. And I realized I should have kept doing that for longer. I should have said, instead of starting this biogas business,
you could have
built the business till I actually had capital.
Yeah. Because even then you are trying to learn the African market, the African farmer, the Kenyan farmer, supply chain.
So I spent 5 years basically not getting paid almost nothing.
Yeah.
Right below the poverty line of the US. And I could have been getting paid as a consultant, getting paid a few $1,000s a month.
Yeah.
Right. And then built up some capital base to do something with. And I learned that. So the next time when I started this consulting business, you make cash right away. You can often charge before you even do the work. Right. Versus a lot of businesses you supply to, I don't know, Uchumi Nakuma, and then you might not get paid. Right. And so being that consultant is a really good place to start as an entrepreneur, to learn what's going on. And so, for Grant & Co., we were able to raise a bunch of capital. We raised, at the end of the day, $20 million for companies in Africa, and learned a lot of the challenges along the way. Our vision at the beginning of Grant & Co. was, how do we make an entrepreneur's search for funding as easy as finding an Airbnb by 2040? Why is it so hard? One of my dear friends, he raised money from Y Combinator, and then he was introduced to Peter Thiel. They met in a coffee shop just like this, you and me. And Peter said to him, sounds good. Let me know how much you want, between $1 and $5 million. I'm sure the term sheet will be fine. Send me your bank details.
Wow. 5-minute chat.
It was a 3-minute, it was a 30-minute chat. Yeah.
Wow. Yeah.
And so then he was an investor, right? And they eventually sold the business, and it wasn't a huge exit, but they made something, right?
Yeah.
And why can't it be like that? Why does it take 12 or 24 months? If you're a commercial investor, that's lost growth.
Yeah.
If you're an impact investor, imagine it's a health clinic and they're saving 100 lives a month. They can scale up to 1,000.
Yeah.
By delaying all that time, you're losing tens of thousands of lives.
Yeah.
So regardless of which side you're on, we would want to move fast.
Yeah.
And the question is why?
Why? Yeah.
And there's a lot of reasons for that I learned in doing the consulting.
Yeah.
So that's what we built into Kuzana.
Yeah.
Those lessons learned. So, and when I talk to people, they're like, oh, this is so obvious. This should be the way it works, right? They're like, this is like, so simple, so obvious. And yet people are not doing this.
Yeah.
And there's just like lots of structural reasons why that doesn't happen.
Very, very interesting. And I think I like the way you mentioned this like talent, opportunity. So do you think like also geography matters? Like, if you were to think of a Venn diagram, like talent, opportunity, and then maybe geography, like, because also you had the talent, geography. You had the opportunity in Kenya, but you tried to like, explore other regions. Do you think also in terms of geography, also like plays makes a case in terms of where to focus on as an entrepreneur?
Yeah. I mean, they say geography is destiny.
Yeah.
In historical context. Like the reason why Russia and Germany always have to go to war is just because of the geography. There's no border really between natural borders. They're always fighting over Poland, right?
Yeah.
The US has the benefit of having, they're separate.
Far away from
they got the water on both sides, and then there's like Mexico and Canada, which is not really a big threat, right?
Yeah.
And you're thinking more about geography as terms of like, what's the opportunity in a space? And it's good to think about that. I think if I wanted to make the most money or the fastest, I would have stayed in the US, right?
Yeah.
But then
because of the ecosystem, I guess.
Yeah. I mean, there's no better, that's the best economy that's ever existed in the history of humanity.
Yeah.
Like there's problems with my country, but it's
quite a lot. Yeah.
There's quite a lot of problems, and yet it's still the best. And so you would kind of have to be crazy not to work there.
Yeah.
And so in a sense, I guess we're kind of crazy, right? But the other thing to think about is just the growth and the potential, and think about things over multi-generational project. People used to build churches in Europe knowing they would never see them completed. So what's a project that I can begin now that I may never see completed? But this gets the church getting built in the right direction, right?
So is it like the term keeps growing, like total addressable market keeps growing year on year, and multi-generation?
Yeah, exactly.
Yeah.
And then like, what's the thing that you can do that no one else can do is an interesting question. Just running businesses in Kenya, and then also being from the US, like how can I bring, the capital, which is relatively low cost, 5%, 10% interest in the US, right?
Yeah.
Here, unsecured lending, 100% interest a year.
So there's like an arbitrage there.
There's an arbitrage. There's an opportunity. Yeah. So you said there's like skill. What did you say?
I was just speaking, you mentioned that the talent and opportunity,
talent
and then
opportunity.
I added the geography just to complete the three circles.
I like that one.
Yeah. So just playing out aloud in terms of,
Yeah, because there's like, traditionally in history, I'm not sure we want to go down this path, but in history, there's three things that people claim determine history.
Yeah.
There's the great man theory of history. So the Genghis Khans and the Julius Caesars and the Napoleons, are they the ones that determine history? Or is it a technological view, which is as technology gets better, these things would naturally happen?
Like probably they have the guns or the rifles or whatever to win those wars, right?
Yeah. And then there's the geography.
Yeah.
So why is Europe so different from China? Europe has lots of different coves and waterways and mountains. And so it's hard for one civilization to dominate Europe, which means there's lots of experiments going on. Whereas in China, it's kind of one big thing, but there's not that much differentiation between, there's not any natural boundaries. So it becomes one big empire. It becomes a totalitarian dictatorship typically, which, snuffs out ideas. So that's kind of why you can see more innovation in Europe. We'll see what happens. This might change in the future. There's no reason why it will stay that way. And geography in Africa is very, very tricky, right? There's very few navigable waterways, right? That tsetse fly has made it almost impossible to have beasts of burden. There's almost no domesticated animals from sub-Saharan Africa. So the geography has just made it very tricky in the past. Now, those things are no longer a constraint. And so that's unlocked huge potential.
Yeah.
So to your point, where do you want to live in the world? Well, I believe there's huge potential here, right?
Yeah. Interesting the history, connotations, and geography, and like how that plays out in terms of opportunity. Now, maybe coming to Kuzana, how did it start? I'm sure there's probably Kuzana 1.0, Kuzana 2.0. Tell us about it.
Yeah. So, there was someone I was mentoring for a program.
Yeah.
and he was doing soybeans. And it seemed like a good opportunity. He'd trained people in soybeans before farming. And he needed a loan in order to actually make this happen. So I'm like, all right, here's a loan, $1,000, go do it. Let's see what happens.
Yeah.
And there's some interest on it. And the harvest was horrible. He didn't harvest anything. He harvested even less than we had for inputs for seeds. You know, he lost his wife left him. He lost his TV, lost his house. I shouldn't be smiling, but it was horrible, right? It was horrible. And he's like, I'm so sorry, Kyle.
A downward spiral, I guess.
A downward spiral.
Yeah.
And so I learned from that, the money was not enough. Right. And even raising capital for companies with Grant & Co., you realize the money is not enough.
There's things that are wastage, there's like, misallocation, poor optimization, I guess.
Yeah. You want your accounts in order. You talk to any investors, they'll be like, yeah, we're still waiting for 2024 accounts. And it's been
6 months,
6 months already, right? And so we realized there's 3 things more important than money. And that is professionalization, which is what you're talking about. Like, do we have the accounts? Do we have our efficient operations?
The engine.
Exactly.
Yeah.
Even if, professional communication and these kind of things. The second is focus, which is getting away from, in the beginning, an entrepreneur does many different things. They're trying things out. The tendency is to keep doing that. But what you want to do is actually focus on the one thing that's actually working. And so instead of shiny object syndrome, to focus, and it's very hard to do because you tend to focus means to cut off either parts of you or parts of your company, which means firing people. It's very emotionally difficult, right? And then the third thing is community, which sounds touchy-feely, but like the people make the thing, right? And Paul Graham, the co-founder of Y Combinator, says, when you put ambitious people together, they bloom like dying plants given water. We've absolutely found that to be true. And I think he had a great insight, which worked well in the US, and I think it works even better here, which is if I ask you which country has a stronger sense of community, you already know the answer to that, right?
Yeah.
Between the US and Kenya. Right?
Yeah.
And yet we invest in Kenya just like the US one by one, right? So, like that's a really critical thing, is to build that community, to build the support and all these kind of, just having someone who believes in you. I remember Hilda Mora had a great talk she gave to Barack Obama when he visited. Belief, power of belief. Like when someone believes in you, you stay up. Instead of working 3 hours a day, let's be honest, most people work 3 hours a day. You can work 12, you can work 14 hours a day. That's a big difference. And that compounds, right? And then you have these people behind you. So these are the things we realized that we're missing. People are just like, oh, how much money is going into these? How much money is going into this? And there's structural reasons why this is, in my opinion, was done poorly. And so you just saw these problems. My friend who couldn't pay me back on the loan, who needed other help, the entrepreneurs we raised millions of dollars for, who, largely did well, but ran into some challenges. And then we saw there was, sexy businesses that often were never profitable. And then there were businesses that were profitable, the unsexy ones. And we're like, why is the money going towards the sexy ones that are not making money? Isn't the purpose of business to make money?
Yeah.
Right?
Yeah. It's like the Cody Sanchez, laundromats investing in, she's done quite well in that.
Yeah, exactly. Yeah. Exactly. And so if you're patient and you stick around, you do a good job.
Yeah. So now, like for you, if you look at the community aspect, like I think we are early days here. We have it like informally in terms of like we have churches, circles, chamas, we contribute to weddings, funerals, but like turning it into as part of your business engine is still, we're still kind of learning and figuring out.
I mean, I've learned way more from Kenya than the other way around, right? Like just that, the chama and the sako, like this is working, right? And the growth is impressive, it's taking time.
Yeah.
Zakayo's taking his pound of flesh. But we'll get through this.
Yeah. And then, so how do you go about convincing investors to back this model? I'm also thinking in light of there have been so many accelerators, in Kenya, Uganda, wherever, and we have seen challenges with, incubators, accelerators in terms of sustainability and the actual value prop to founders, to entrepreneurs.
Yeah.
Obviously, there are a couple that have done quite well. They have, a tech niche. Some have climate niche and other sort of sectoral niches. But for most of them, the playbook is program by program, start, stop, cohort. Then, funding runs out. They go through another proposal writing season, get a fund, and then sort of onboard a next cohort. So there's also breaking of that sort of chain.
Yeah.
So how did you sort of navigate all through that in your journey?
Yeah. I think a lot of accelerators have put their pants on before their underwear.
I like that. Pants before underwear.
Yeah. So it's a bit of an ugly situation. And what I mean by that is if you focus on climate or gender as the most important thing, you've forgotten the most important thing, which is money.
Yeah.
It must be financially viable.
Yeah.
And so if
you put the theme above the underlying
the
business
foundation.
Case.
Yeah. So as Peter Thiel says, a company broken at its foundation cannot be fixed. An accelerator broken at its foundation cannot be fixed. Incentives determine everything. And so if you're incentivizing a focus on one thing to almost a religious extent, I think, climate is important, but,
at some point it's very dogmatic.
It becomes very dogmatic.
You might lose the underlying economics.
Not to mention that Africa is like 0.1% of global emissions come from Africa or whatever it is, right? So it's like a drop in the bucket. It's like, what are we doing here? Right? If you're so obsessed about climate.
It's like putting the people who have done the list to solve everything, right? So it's like, telling us to buy solar, to do all that. Yes, we do. Kenya is 80% grid is green.
It's way more
than anywhere else.
Yeah, exactly.
But there's still this kind of push,
dogmatic religious push. So I think it's just getting back to the first principles of these things. And so there's sexy software accelerators, and those ones have tended to do pretty well. Y Combinator, 500 VC, 500 Global, Baobab Network, and then
Stars as well.
Seed Stars as well. And so it becomes, Y Combinator did about 10 times better than 500 VC, did about 10 times better than Techstars, which did about 10 times better than Seed Stars. So there's this huge order of magnitude thing. Which
between the first and second best.
First and second.
There's a winner take all.
It's a winner take all dynamic.
Yeah.
Even way more than for a VC fund, which is kind of crazy.
Yeah.
And so you do need to be the best accelerator. And the thing is, the best entrepreneurs want to do what? Make money. Right? So yes, it's great to have an impact and all that, but the important thing is for them to make money for themselves, their family, their community. Right? And I think that's the right way, bottom up approach rather than the top down. I'm always, bottom up thinking on things.
Yeah, 0 to 1 kind of mentality.
Yeah, exactly.
Yeah.
And so for us, our goal is to mint 1,000 more millionaires.
Yeah.
And that's something that's really resonated with people, with entrepreneurs, which is let's become millionaires. Then we can do what we want with our money. We could be the next angel investors to, catalyze this whole ecosystem, and they can be even much better investors than I can, right? So that's the general idea.
I look at the co-founder of Flutterwave and what they've done with his venture building at Future Africa. So I'm assuming if you have successful founders and there's Pani from Ken Joroge ex Cellulant.
Exactly.
So there's there's evidence to show that a founder is probably more likely, if they are successful, to back more founders. But they also have to keep their head above water before they they write more checks.
Put your oxygen mask on before helping others. Is is the thing.
Yeah. I like the oxygen mask and the pants before shots analogy.
Yeah.
And then there's one thing you've also mentioned in some of your pitches around the VC model and the problem. I think we've lost more than $2 billion chasing unicorns in Africa. And then that's sort of the counter pitch to Kuzana in terms of the boring elephant type businesses. So maybe if you were to diagnose the VC model, and then let's diagnose the use case for the boring business.
Yeah, sure.
Because I'm assuming also you're also chasing money that people have traditionally been putting into VC type stocks, right? For example, if it's angels or other early stage VCs and LPs. So I'm assuming like there's also like an argument for rechanneling or repurposing some of those funds where they're being deployed currently.
Yeah. So the challenge, the VC model, it was designed actually for oil wildcatting in the US in the 1950s. So it's a model that's more than 70 years old. And it wasn't necessarily designed for this context. To get a bit technical for a second, the way the model works is you earn 2% management fee on the amount of money you manage. So if you manage $1 million a year, then that's only $20,000 of management fee. That doesn't work. You need to manage.
So it incentivizes you to raise large funds for it to be economic.
May incentivize you to have huge funds. But 2% on $100 million, now we're talking, right? Now people are like, hey, I can definitely get on. And I'd say especially the unscrupulous VCs, they raise the money just to get the management fees, knowing they'll never make a return. That's one dynamic. The other dynamic is if you hunt for deals individually, then it's very, very expensive to find a deal. And you have to find these very big deals, and there's just not very many. It's just the ecosystem's not there. It's just there are not that many $10 million deals.
Because if you raise the $100 million for the management fee, then you're going to have a pipeline issue, right? In terms of deploying, efficiently and at scale, right? Because not so many companies have the absorption power for large rounds.
Exactly. Exactly. So what's fit for purpose? And so what happens from there? Then they end up having lots of different LPs, mostly governments. They have lots of paper pushing they have to do. So you wonder, why is the VC being so frustrating to work with? 80% of the money on the continent for VCs is from governments. And if you think the Kenyan government is frustrating, try the US government, And story about that one later on. A little teaser. And so then you end up not being able to help the entrepreneur. You're just trying to make sure you get the money. And if Trump cuts something, you're trying to backpedal, and you're dealing with that whole thing. And so, because of that, then you're looking for these certain size deals. They also have very strict requirements. There's a friend who's doing VC, and I'm like, so can you invest in Kenya? You got some fresh capital? He's like, yes, I have capital, but I'm only allowed to invest in women in Nigeria with the rest of the money. Because we have to do 50% women, 50% men, half Nigeria, half Kenya. And I'm like, we only have it's like, if there's a good deal in Kenya, he can't pursue
and
it.
then I guess this is going back to your point. It's like part of the top-down model, right? People are, pre-selecting outcomes before building up these, VC capital instruments from ground up. Like we start off with a government in Europe saying, I want money to support Nigerian women-led SMEs in climate. In
sounds very good.
3 provinces or
sounds
3
very good.
States.
Very reasonable.
But no one is thinking about, is there actual bankable pipeline? So it's sort of like start this end, value chain, sort of, upside down kind of.
Exactly. So, and it's normal for an ecosystem to do that. I spent in that 3-year motorcycle trip, and after that, I've spent the last 5 years studying entrepreneurship. I got a self-directed PhD, I would say. I've read so many books, founders podcasts, which I can recommend as well to people. I probably listened to almost every single one of the 300 podcasts, which is about an hour long. And what was the commonalities in VC and different things? So I read a book on history of VC, And originally, the government was very involved in the US in VC. And they you kind of had the wrong incentives in place. And then eventually, the VC industry took off. So the good thing is the governments are catalyzing this. They've built the interest. People are aware of it. They're talking about it. They've sensitized people. So we want to come in right when there's interest. Because most people don't even know how equity investment works. I went to see 40 branch managers in Kenya of banks. The idea was to get deal flow from them. And so I'm like, okay, so we're an equity investor. We want to partner with you. And
so deal flow from their customer base, their
exactly,
SME customer base.
Maybe they're too risky for you to invest in. They're too early stage. We can co-invest.
Or they're maxed out in terms of their credit allocation to that business.
Exactly. Yeah. And 38 of the 40 said, hey, so what's your interest rate? I'm like, oh, there's no interest rate. That's not how equity works. And so there's just not the awareness of how equity works. We're just getting to that place now, right? And so I explained to them, and they're like, "Oh, cool, that's interesting, yeah, right?" But that's just where we are at right now, right? As an ecosystem, which is good. I want to be there. I want to be there at the beginning, right? So then, how do you actually make it work? And it feels like the timing's really good. There's a company called Africa Eats I always direct people to. I had a podcast myself. Podcasts are so valuable. I can highly recommend anyone to start a podcast. Sorry, they're going to compete with you, Daniel. But or maybe you'll acquire them. You'll have your own podcast network sometime. Because I didn't get that many viewers, but I interviewed investors. And one of the best ones was with this guy named Looney Libis, who had a company called Africa Eats, and they invested in early stage, 40K check originally, African food businesses. And I was like, this makes sense. Then he was raising some money. So I put some money in. And like lo and behold, then they went public last year in Mauritius. And I had a 31% return IRR per year.
Which is like...
It's good.
Yeah. Like if I compare with NSE, Nairobi Securities Exchange.
Even New York.
And it's
like 3 times. Yeah, 3 times. So he did very good. But he's had a hard time convincing people. The same thing I'm saying about sensitizing the ecosystem. He's had that same challenge in the US and everywhere.
You become like first the educator, and then like the model starts preaching for itself, right? So you...
Exactly. So we're coming in on his heels to try to benefit from what he's done. And so I thought this model made a lot of sense. I met him through doing this podcast. And so they've done very well. And so, we're just kind of iterating on what they've done.
Yeah. Interesting. And then like maybe on that still, so holding Horizon would be, I guess, 7 to 10 years with, it's more like the Berkshire Hathaway. I'm just regurgitating it for the sake of the audience, just to understand how it works. Maybe you could just
talk about Kuzana and how it works. So we're an education platform disguised as an acceleration fund. So we invest 40K in quote unquote boring businesses, meaning ones that are looking profitable, ones we think can grow to 100 million shillings a month in revenue in the next 5 years. And so it's a 12-week accelerator. So you meet one day every week. With the first one for batch 2 is coming up tomorrow, which is exciting. It's on sales. The last one for sales, the companies were able to increase their sales by about 50% by implementing what they learned. It's extremely practical and not at all about like, here's the general theory of sales. Like, what sales problem are we having this week? So we invest capital in these companies for equity, stake in their business. Depending on the valuation, depends on, the percent we get. And then we hold as long as you want us to. So there's no limit. Like Berkshire Hathaway, Warren Buffett, he used to be the richest man in the world. He said his favorite holding period is forever. Why would you divest from a company growing, 50% year on year, right? So most investors, they have a 10-year fund. That's a traditional VC thing that came from the wildcatting oil in the US, because in 10 years, a well's dry, right? That's not how entrepreneurship works though here. The well's not dry in 10 years, right? Literally, it's not, right? And so, it's kind of just getting started. So that's what we do. And then we ourselves we'll go public on the NSE, Nairobi Securities Exchange or something like that in 7 years. So we can get liquidity for our investors. But and then we're, setting up a debt fund next to provide very affordable working capital. Because, the base rate is 100% annually in Kenya for uncollateralized working capital. We can bring it down a lot. and get good returns for our investors in the US. And so that's where the community comes in too. Like once you have trust, you can start lending at a much lower rate because it's like,
and then you're also lending based on data, right?
Based on data.
You're basically making decisions that are backed by the data that you're seeing from the companies.
Exactly. Yeah. So as far as professionalization, which I mentioned is the first thing it's more important than money, is getting the accounts in order.
Yeah.
And so we just do the accounting for the company because why should they got to do 1,000 things. Why should they do accounting? We can do accounting cheaper, faster. You know, if there's a problem, I can complain to myself about it, you know, rather than complain to someone else. Right. And so the other week, entrepreneur came to me. He's like, hey, I want to raise some more money. I'm like, okay, let's take a look at your accounts. I was like, okay, sounds good.
Yeah.
Sent them the money the next day.
Yeah.
Right.
Yeah.
Like it looks like you're going in the right direction.
Yeah. I think you've answered a couple of questions around business challenges. I think credit rating is still a problem, and I guess that's why the base lending rates are high, and because it's like shooting blind. All these lenders are like overpricing for maybe perceived risk. So it becomes very expensive for entrepreneurs to use that type of capital and in the manner it's structured in terms of growing a business in a much more healthy way, right?
Yeah. Well, there's a few things around the lending rate, which is banks mostly invest in treasuries because they can guarantee they'll get 15% returns. Also realize that the banking system is a cartel. I don't mean that to be insulting. I mean that in the technical sense. Right. And so they don't actually have an incentive to change these kinds of things.
It's not broken from their side.
Exactly.
So why fix it?
Exactly. For them, it's working great.
Bonuses are flowing.
African banking, I think, is the most profitable banking sector in the world.
Wow.
Yeah. That I was looking at. So, people inside the system don't want it to change. And so in the CRB, there are some banks that I'd say some exception is there are some banks that will provide uncollateralized lending. And so really shop around. I used to think all banks are the same. I now only think 90% of them are the same. And so if you shop around, it's definitely helped our investees. Having an American investor on your cap table doesn't hurt, right? And as far as having those conversations.
Because it opens up access in terms of pools of liquidity that otherwise you would not have met. And then the other questions around how do you reconvert some of these businesses that are traditionally boring to embed now like tech, social media, AI. You've done it quite well as the accelerator. So how do you sort of what are you seeing as some of the use cases for them to sort of apply these tools and deploy them efficiently to their own businesses in whatever way they think that this will be helpful?
Yeah, I think using tech properly is a huge lever. And I use, boring in quotes as a marketing term to get distribution on social media. Like that's the world we live in, don't hate the player, hate the game, right? But these are very exciting business. Like making a profit is exciting. Having your house auction because you can't, pay for it anymore is not exciting.
Now that's boring.
that's the kind of excitement I want to avoid. And then the thing is, a lot of this tech has already been built. So I'll give some examples. Like one company, they distribute, feed, but they get 90% of their leads from Facebook, right? And so how can you leverage these technology that already exists? The tendency is to build your own tech. We've talked to a lot of companies that are tech-enabled, and we tend to stay away from those ones. They tend to be overvalued, and building your own tech is very expensive. I think one of the things, this is the contrarian point of view that many people might disagree with me and hate me for, but I'll say it anyway, is that I think tech is generally a bad investment in Africa because the market is extremely small. So all of Kenya is half the size of San Antonio, Texas as an economy. So you go to an investor and say, hey, we're going to build a social media app for like south side of San Antonio, they'll laugh you out of the room. And on top of that, most of the best opportunities are taken. So the Netflix of Kenya is Netflix, the QuickBooks of Kenya is QuickBooks, the Facebook of Kenya is Facebook. And so the thing is, there's some opportunities in tech there's not that many. The thing is, how do you leverage those things to build the things that people actually need? Like they need pork, they need soybeans.
And then also, like, sometimes if you embed tech in an already existing distribution, like well-known, like for example, some of the credit scoring fintech companies partnering with banks to do it for their own customer base that's already there, right? It's sort of, reconverting this manual, boring, long, winded process into a 2-minute in and out kind of process. But it's sort of like you're not, the cost of acquisition is very, very low, right? Because, it's sort of like, an on-ramp you sort of, plug into an ecosystem. But for most of, these tech-enabled businesses, you're chasing the money, also chasing, trying to figure out who's the actual customer you're targeting. And then for it to work, as you said, if you're building this tool for Kenya, then do you need 100% market share for it to actually really scale, right? Because, for example, there are businesses that in Europe, US, as long as they have 5%, they're $1 billion, valuation company, right? They're already a unicorn.
Exactly. And then think about like what the advantages are of this geography. So the best developers can also get a job at Google. So you're competing globally. Versus like the best avocado picker, they're not competing. They can make $100 a day in the US, but they can make maybe $3 a day in Kenya, right? So, pay them $350 and they're happy.
There's a friend of mine who has, he's very into like this Uber ecosystem and logistics. So he was telling me the most loyal Uber drivers in terms of ratings are those like maybe they are former construction workers, so they were earning like $3 a day, in a rural or setting,
breaking their backs.
Breaking their backs, very, very manual, very tiring work, and then they just get a driver's license, and all they need to do is just hop into the app and start driving. They sort of value what where they're coming from, and they are much more embedded into the gig economy, as opposed to say someone who was like had an office job and they lost their job and then they had to do Uber, because they're always like, so I get your point in terms of like you're this African startup and you're pitching to potential Google employees. They'll probably take it only as a sort of, a plan B, or like sort of like wait and see kind of when Amazon or Google comes knocking, they'll just, leave.
Yeah. There's a few people I know building tech talent in Africa, and they're like, oh, we're building this thing. The thing is, as soon as you build the tech talent, they leave, So you're just like, all you're doing is you're helping Facebook acquire cheaper talent.
It's an export model at the end of the day.
And then you're not able to capture it because you can't you can't sell the people. That's illegal now.
I hear your point. I think that's sort of valuable to frame it that way in terms of this avocado picker would be hopefully embedded within your supply chain for a good portion of their lifetime. So the lifetime value of customers, suppliers, everyone in that ecosystem is longer, as opposed to tech talent that you keep retraining because the last batch left 2 years ago, and you have this sort of start-stop model. Maybe talking about, I think you mentioned about failure. So I think that's quite covered. Maybe from this Kuzana model, we know the traditional VC model, there's this like rule of thumb of invest in 190% fail. And then you're trying to flip the failure rate almost in the inverse. So what would you say are things that you feel that could bring the failure rate more and more down to, I think you're targeting single digits, and also you're optimizing. So in terms of others who are thinking about similar accelerators in West Africa, Southern Africa or other places, like how do we repurpose to mitigate the failure rate that traditionally has been high in the African entrepreneur market? Yeah, is it in terms of funneling, targeting businesses, or where do you see as the touch points of managing failure?
So there's 2 points there. You have failure, and then how can someone else implement something like Kuzana again? So if someone wants to do it on their own, Fledge Looney, who now runs Africa Eats, mentored us, and you can license their model. It's not very hands-on, but it's a great place to start. I think it's something like
because I assume also you would probably at some point be open to licensing and such.
Exactly. So with Looney, I think it's like $11,000 a year or $11,000 a cohort per batch. For us, if we're very interested in licensing to other markets, I see Rwanda as potential. I see Malaysia as potential. I see Morocco. I see, Peru as potential places where the same kind of thing could work in the local context, as long as the incentives are aligned, which means that whoever's there is a founder themselves. They do have a huge network and they put in their own cash. Something like I put in $50,000 into Kuzana to start it. So they would, do the same thing. And then we could help them raise money with the same brand or whatever it is. So if anyone's interested, now or some day in the future, they can reach out to me on that. In terms of lowering the failure rate. So one thing we do is we invest in companies that already have product market fit, I would say, and are very low risk. Like avocado, I can't imagine a future where people will not be eating avocados. As Jeff Bezos says, instead of thinking about like, how will the future be different? How will the future not be different? He can't imagine a world where people will want higher prices or they'll want slower delivery. It's not going to happen, right? And so for us, I can't imagine a future where people don't want to eat pork. They don't want to eat avocados. They don't want to construct their houses. And so those are the things that, we don't have to think about the future too much because it's, it's like already here. So those are the things we invest in. They're already quite established. There's not much of an interview process or like due diligence because it's like this company, this founder's been running this for 3 years. Like that's the interview.
So as long as the proof is in the pudding,
the proof's in the pudding.
Of course, you have to think about like age of the founder, if it's a family business, succession, governance. But I guess that's part of like now
those are some of the details.
Post-investment kind of support.
And there's one company that we're looking at that they were about to go out of business and their shareholders just needed to be out. They needed to move on with life. They needed to, build their houses and help their families. Or the CEO wanted to continue. So we found a way to buy them out, restructure the company, and then it was a win-win where we got a chunk of this company that's growing. So it was like a micro private equity kind of thing. So sometimes you have to be creative. And that's like the fun part, know? So that's
because I'm assuming then the investment in some cases might not be straight up equity going for growth. It could be like taking out investors, repurposing your cap table, etc. So
and it's just about being creative. Like you don't need, if you're buying someone out, you don't pay them cash today. Right. You see newspaper headlines, so-and-so raises X amount of money. The famous
they
one
don't
was
know the earn-out and
Market Force or raises 40 million or whatever it was. Well, they got some money up front and then their investors apparently, didn't give them the rest of the money, right? The earn-out, like you said. So you agree on a certain price.
Drawing down,
and then there's some conditions, like they have to be supportive throughout the process and they get paid out over the next 3 years. And, like those are typical ways that you buy a company. Usually don't buy cash with this briefcase, and like, here's the money, and then, so how else do you, reduce the failure rate? So just having those things I talked about, the professionalization, right? Getting the accounts in place, making sure you're paying your taxes so you don't end up in jail. Have like, what's the plan B of if the founder gets sick or something like that, then have the accounting and all those kind of things, have the community around them to support because burnout is real. But you know what? So the thing that I did a few acceleration programs and I did Strathmore and the thing that was the best was not the class. It was the people. It was the drinks afterwards, laughing because you cannot tell your customer your problems. You can't tell your employee your problems. You can't tell your investors your problems.
You can't tell your friend.
You can't tell your wife your problem, your husband, too many times before you create new problems, right? And so you need people that are your peers, right?
Yeah.
And we try to be the peer as much as possible. But at the end of the day, we're still the investor.
Yeah.
So they,
So you're like also like democratizing the problem solving, decentralizing it to the peers in that cohort.
Exactly.
Otherwise, there's still like at least some level of hierarchy. As much as you try to befriend and be close, and they know, like, you know, they have expectations as
And in a lot of ways, I'm working for the entrepreneurs. So it's like it's a boss employee. I'm also the employee as well. Trying to, because we have no control over the companies with a minority stake. And I talked to a few investors in the US about this. To your question about how to raise the money, because I was like, this makes sense. This is going to work. And they're like, this is not going to work, Kyle.
Wow.
You're going to lose your money. You're going to become poor. There's no honor in being poor. Your wife is going to leave you. Literally said, your wife is going to leave you.
Wow.
Right?
Yeah.
And I'm like, I think he's making a few mistakes. They're making a few mistakes in here.
Yeah.
But also, I want to prove them wrong.
Yeah.
You know?
Is it like is there like similar models for? Because I'm assuming like in the issue in the US, because of liquidity is, you know, way better than here. There's like less and less need for like this Kuzana boring type business. There are lots of like mid-level, mid-tier PE, and lots of like exits opportunities from corporates.
I mean, there's less need because there's so much capital. Also, the government provides like guaranteed loans. So anyone can buy any business, right? Just with their personal credit. And so there's like just less need. There's also less opportunity for these companies. Whereas those companies are mostly kind of shrinking in the US. Here, they're growing.
Pops, the mom and pops are shrinking because also I think there's like generational shift. Like, you know,
the boomer
is sort of aging out, and the kids don't want to.
You mentioned Cody Sanchez. So the opportunity more is in consolidating these mom and pops. Whereas here, the opportunity is a bit,
scaling them
is
actually.
different. Exactly. They're investing in 60-year-old plus businesses. We're investing in entrepreneurs who are 27 to 35 typically.
Cool. This was fun.
This is fantastic.
Thank you for having us, sharing your story. I'm very, very, very exciting to see, different opportunities for angels, for VCs, for, people just to support founders in alternative ways than the traditional models. So we'll share a lot about your platforms where people can engage, connect, and reach out.
Yeah, please do. We have a community on WhatsApp, so people can come there
join
and hang out. It's a lot of fun.
Cool. See you around. I know you have to rush to Machakos for a DD visit, so all the best.
Daniel, I cannot thank you enough for doing this and offering us this platform to talk to your audience. So I really appreciate it, and thanks to the audience for listening.
Thank you.